Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's top stories with you. We're starting off with a look at the current market trends, and it's clear that investors are getting nervous. The Indian stock market is experiencing some volatility, with the Sensex and Nifty seeing declines due to concerns over U.S. tariffs. Yes, you heard that right. U.S. tariffs are having an impact on the Indian market. According to experts, the Trump administration's upcoming announcement of extensive tariff plans has got investors shying away from risky assets, fearing it could hurt the global economy. The Dow Jones Industrial Average has already fallen sharply, with a decline of over 290 points, and the S&P 500 and Nasdaq Composite are also seeing significant losses. But what does this mean for Indian investors? Should they be worried about the impact of U.S. tariffs on their investments? Well, experts say that while there may be some short-term volatility, the long-term outlook for the Indian market remains positive. In fact, some stocks are even seeing buying interest, with over 62 stocks hitting their 52-week highs. Of course, it's always important to keep an eye on the bigger picture and not make any knee-jerk reactions based on short-term market fluctuation. As investors, we need to stay informed, but also remain calm and rational in our decision-making. We'll be exploring this topic further, as well as other top stories from the world of stocks and finance. From the impact of regulatory tightening on financial inclusion to the latest trends in IPOs and infrastructure investments, we'll be covering it all. So, stay tuned for more insights and analysis on the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're joining us again for this segment of the show. Today, we've got a fascinating story that's making waves in the world of finance and investment. You might have heard about BlackRock CEO Larry Fink's latest letter to corporate executives and shareholders, where he shares his vision for the future of private markets. Now, I know some of you might be thinking, what does this mean for me? Or how will this impact my investments? Well, let's dive in and explore this story together. According to Fink, traditional asset management is no longer sufficient, and BlackRock is looking to transform itself into a firm that manages money at scale across both traditional and alternative assets. This means they're investing heavily in private assets like real estate, infrastructure, and private credit. In fact, over the past 14 months, BlackRock has committed a whopping $12.5 billion to buy global infrastructure partners and £2 55 billion for data firm Prechem. Now, you might be wondering why this is significant. Well, Fink believes that the traditional 60-40 portfolio of stocks and bonds may no longer be enough for diversification. Instead, he suggests that a new normal for portfolios could be 50-30-20, with 20% of investments being in private assets. This shift towards alternative assets is expected to provide higher returns over the long term and help guard against downturn. But here's the thing, this isn't just about BlackRock or its investors. Fink's vision has broader implications for the entire financial industry. He's calling for greater transparency and accessibility in private asset valuations, which could potentially open up these investment opportunities to a wider range of people, including individual investors and retirement funds. Of course, there are also potential risks and challenges associated with this shift towards alternative assets. As Fink himself notes, the US dollar's status as the world's reserve currency is not guaranteed to last forever, and the country needs to get a handle on its debt. Additionally, the increasing demand for energy from data centers and artificial intelligence could lead to an unacceptable trade-off between individual energy needs and computational power. As we consider these developments, it's essential to maintain a balanced perspective and avoid getting caught up in hype or speculation. After all, as investors, we need to be aware of the potential risks and rewards associated with any investment strategy. So, what does this mean for you? Well, if you're an investor, it's essential to stay informed about these trends and consider how they might impact your own portfolio. If you're a financial advisor or planner, you'll want to pay close attention to Fink's vision and its potential implications for your clients' investments. As we wrap up this segment, remember that the world of finance is constantly evolving, and it's crucial to stay adaptable and informed. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's show with a story that's been making waves in the tech world. The Nasdaq 100 has just wrapped up its worst quarter in years, and it's all due to concerns about an AI bubble. Now, I know some of you may be thinking, isn't that the future of technology? And you're right, it is. But the question on everyone's mind is, have we gotten ahead of ourselves? The tech giants, including Microsoft, Alphabet, Amazon, and Meta, have been investing heavily in AI research and development, with plans to spend over $300 billion in the current fiscal year. But some experts are warning that this spending may be unsustainable, and that we're seeing a classic case of supply outpacing demand. Alibaba's co-founder recently sounded the alarm, saying that the rush to build new data centers is getting ahead of demand for AI services. And just last week, an analyst report revealed that Microsoft is walking away from new projects in the US and Europe due to oversupply. This has left investors nervous, and the Nasdaq 100 has taken a hit as a result. Now, I want to be clear that this doesn't mean AI is going away anytime soon. In fact, many experts believe that AI will continue to play a major role in shaping the future of technology. But what it does mean is that investors need to be cautious and not get caught up in the hype. As one analyst put it, the questions about AI are coming at a time when there's increased uncertainty overall, and at a time when they were priced for perfection, or close to it. This is a reminder that even the most promising technologies can be vulnerable to market fluctuations and investor sentiment. So what does this mean for you, our listeners? It means being vigilant and doing your due diligence before investing in any company or sector. It means understanding the risks and rewards and not getting caught up in the excitement of the moment. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.